But without further ado, I wanted to hand to our two partners who are coming out of Australia, Brisbane, Australia. And Fiona there's two partners, Fiona and Nathan. So Fiona is really, really interesting. She basically was part of Knight Frank, and she was based in Australia. And then if you don't know Knight Frank, it's one of the biggest real estate companies in the world. She then went to Singapore, and she was based out of Singapore looking after the Asian office, and then actually went to the head office in London, and was on the executive committee of Knight Frank worldwide. In over a 10-year period, both between Singapore and London, she was involved in actually curating the wealth report. And there's two sides to the wealth report. You've got the Chinese component, and then you've got call it the European component. And she was actually involved in both of those, running a team of roughly 80 people around the world that were curating and putting all this information together. So you're literally dealing with one of the most respected people globally in terms of looking. And we're going to go into the wealth report and what it's all about. But in my understanding is that it's sort of the one report globally that they look at high net worths. What are the investment trends? What are the sentiments? Where are they looking at? What are they investing in? So it's, we always talk about trying to get the information and the knowledge of what the top 1% are doing so that we can invest like the top 1%. So, for me, there's probably no better person than the person who actually was part of creating the wealth report. And then her partner, Nathan, is actually comes from the medical and wellness, like health background. And they built up the first private or public REIT in Australia, all in the medical and health space. And I'd probably be easier if I let them talk to their credentials in terms of what they did, but is very, very well respected in the market in Australia and New Zealand in terms of the whole medical and health space, but primarily in the real estate space. So this is the wealth report, and I don't want to take any sort of music out of their dance, but they're going to go through this and let us know what the wealth report is all about. I've been following this report for the best part of 10 years, so it's amazing to actually hear it directly in terms of the results. And then this was the REIT that Nathan and two other people co-founded and set up in Australia. So without further ado, I want to hand over to run through this asset class for this month, which is the whole commercial real estate and co-living. And Nathan and Fiona, wonderful to have you here. I hope, I always find introductions very hard because I never quite know what to say or not to say. But needless to say, our focus is always to get the right information and the right partners. And I think you guys come with tremendous credentials. So I look forward to what you're about to share with us.
Thank you, Scott.
Thanks, Scott.
So tell us just a little bit, Nathan, because I know you always tell me when I'm meeting, we can see the view there, and it's obviously nighttime in Australia, but we've got the city right behind you. So just give a little bit of context to not only the Australians, but everyone in the rest of the world. Where are you in Australia, and why can we see the city right behind you?
So we're basically in Spring Hill, which is a suburb that abuts the CBD in Brisbane. And it is actually quite a convenient place to have the office because the kids' school is basically a kilometre away. So you've got the top schools, you've got the boys' grammar and the girls' grammar, and then you've got everything in the city. So it's actually quite a very convenient location.
Yeah, and I think, as you said, the main high street is sort of 2 k's away, pretty much. So like those lights behind there are actually the city behind you.
Yeah, that's right. Even though it looks like we live in a tree house, because it's a very greeny little aspect here, but we are right in the heart of the CBD.
Yeah.
Hopefully we won't have any helicopters going overhead. Yeah. So
the Olympic City.
The Olympic City, that's right.
So guys, quick one. In terms of your presentation, it'd be easier probably if you share from your side, because I think it's easier to share the slides when you want, but I've got it if you want me to share on my side. So I'm easy either way.
You mind? That'd be great if you did.
Okay, no problem. Let me just get it up.
So Scott, maybe I'll just do a very brief introduction on myself and
no, please, I'd love you and Fee to give a better or more comprehensive or whatever. As I said, I always find it a bit tricky. I can share with people your LinkedIn profiles and all that, but I think what's always better coming from the horse's mouth.
Yeah, I understand. And then Fee can do her background and then roll into the presentation. But when I sort of generally tell people sort of background, it really does start with my father, who is a retired surgeon. and he is Australian trained and New Zealand for that matter. And then when we were young, we went overseas and he trained in England and Scotland to become a Royal College member surgeon there. And then in America at the world famous Mayo Clinic. And we basically came back here to put his children into the education that he wanted here in Australia. And with that background, there's a lot of things that he identified, and mum was also a registered nurse. So we've sort of been brought up at the kitchen table around health care and had a very big bent on what I'd call preventative healthcare as well. And with that in mind, and with some of the trends that were going on overseas, we formed our first healthcare company in 1992. Now, that company, which was called Health Corporation of Australia, that company ended up in its various iterations, because sometimes it got bought out and rolled into other companies and etc., ended up becoming the third largest privately owned hospital group in Australia. And that's what Scott shared with you, the screen. And the brand of that is called Healthy Care. That still exists today. I was the founder of that with, as Scott said, two other people at the time. One of them was a family member, one of them was an investor and the executive chairman of that group. And that's still going today, and it's still that third largest group. The other entity that we structure that we set up that is relevant regarding properties, that we formed the first healthcare REIT in Australia, and that was in about 2001. That was called the Essential Healthcare Trust. And in various iterations, that again is now a publicly listed entity that is quite a large, one of the largest listed healthcare property REIT on the stock market. So there's a long background in healthcare. I've really condensed it in terms of the story. And at the moment, we obviously still have some of these assets that we're looking at now. And we also have some preventative medical technologies. That's a growing area that we've invested into. But the space that we're about to go through, which you'll see in Australia, is not really well presented, or in particular within Brisbane, is this lifestyle / co-living. There's a few different terms that get used globally that Fiona will touch on that may be more familiar to you all. But pleasure to meet you all. That's sort of a high-level snapshot of my background, and I'll pass to Fiona to sort of pick up the baton from here.
Guys, just a quick one. Just a conscious, there's a couple of comments coming through. If you can just speak up into the mic, because it's coming through.
Okay.
I specifically turned the settings down because Australians tend to talk loudly. So no, I'm joking.
Okay, so over to me. Hi, everyone.
Can you hear?
Is that okay?
Is that better? Yeah, I got you. I no?
Okay.
Yeah,
Yeah?
little bit higher. Yeah.
I'm a little louder. So as Scott mentioned, I worked with the Knight Frank Group. I was actually with them for 17 years. I started actually with the Ray White Group in Australia, which is a general agency group of about 700 offices, and I worked for them for 8 years. And Knight Frank acquired one of their franchised offices, and I moved across and started with their Australian business on the residential side. And then I took over the commercial business and moved to Sydney in 2004. And then Australia obviously has a very big influence on what was going on in the Asia Pacific market. So I moved to Singapore in 2010 and took over marketing, digital communication and residential at that time for the group based out of Singapore. And I was there for 4 years. And then I relocated to London, and I had the role as global head of marketing, digital and communication for the group worldwide. So underneath that tucked the wealth report. I had to make sense of all this data that was coming out of research and what that actually meant for an end user and a client. And I was actually very lucky that I did 10 of the magazines. And I was going to chat through that today with you to try and distill a few of the key points and bits and pieces of the appetite of what high net worth clients are doing around the world, and just to showcase some of the key findings in the report, albeit this is not one that I've done. So I will have to refer to my notes because I haven't actually done the data myself. But that's what we're going to do today. Just step through some of those bits and pieces and some of the key markets and the key opportunities.
Awesome. And Fiona, just before you guys get going, I just want to repeat some of the stuff Nathan said. So because a couple of people, Mari said she didn't quite hear it. So in simple terms, Nathan's family comes from medical. His dad is a doctor that went to the Mayo Clinic. His mom is a nurse. They've pretty much been brought up medical. In 1992, they did their first health corporation. That turned into the third largest privately owned medical company in Australia, which ultimately became known as Healthy Care, which is the one I shared with you. They then did the Centre Healthcare Trust, which was the first REIT in Australia in, I think you said 2003, in that process. And so been very big in the whole medical commercial space, real estate, property, but the whole process. And then more recently has been getting into other lifestyle healthcare products. I know we don't have time today and it's got nothing to do with what we do, but Nathan's in a fascinating space in another company where they actually do concussion for rugby players, Aussie rules players, whatever, right from the World Cup through to school kids. So with using 3D imaging and what's it called, VR. So yeah, just a fascinating sort of right through from the real estate space right through to the latest technology in the space in terms of that process. So yeah, I hope, Mari, that helped. And Nathan, I hope I took good enough notes on what you said. Awesome. I think, Fiona, we heard you loud and clear. So I won't repeat it all. So cool. Let's rock and roll. I think in terms of where we're at, if anyone's got any questions, fire them into the chat box and we'll get to them. I will share the report here. I've got it, got the screen up. So yeah, just fire when you want me to change screens. It should be loading up. Yep, you've got it there.
Okay, so just a little bit of background. The Wealth Report has been around for 16 years. As I said, I had contributed to 10 of them. My last was the 2018 report. The whole idea of the Wealth Report was to provide the clients and share information with the high net worth individuals in all the key markets around the world, and to position, obviously, the company as the sort of thought leader, best in class on all wealth movements, whether they be property to investments of passion, etc. And it also helped clients make informed decisions. There's when the Wealth Report launches every year, which is in the first week of March each year, it does a roadshow around the world to all of the key clients in key locations of New York, London, Paris, Sydney, Beijing, Hong Kong, and that gets together all of those high net worth clients plus their wealth advisors, and they actually reveal all of the information and share all of the data. So, Scott, just the next one.
Cool. Yep. Sorry, I'm just trying to, my computer's playing games here. So I'm just trying to figure out why it's, anyway, there it is. I'm supposed to have split screens, but it's playing games with me. Anyway, it's all good.
So just wanted to set the scene of what the audience is and what this data is all about and what I'm going to talk to you about. This data is all the client appetite. So the firm goes out to all private bankers and wealth advisors, intermediaries, family offices, a select group of around the world of about 500 people who all contribute to the survey and the findings of all of this data. Some of those banks are obviously the key ones in all of the markets: ANZ, Bank of Singapore, HSBC, Macquarie, Rothschild, UOB, UBS. So all of the key banks, but they do change on an annual basis, just depending on who has the market share, if you like, of those high net worth and ultra high net worth clients, and who's got the data that's required. So this is not data that's come directly. A small amount of it will be from the actual high net worth individual themselves, but most of it is actually from their advisors who give the information on their behalf. Scott, just the next one.
Coming. I'm not the best PA in the world. I apologize.
Oh, okay. Just go again. Something's gone wrong with that slide.
Yeah.
Oh, you missed one for me. That's okay. I'll just go through. Is there one back?
That one.
I just wanted to do. There we are. Yeah. This is just a little important. And then I'll keep referring back to this because it just clarifies what I'm talking about when I talk about assets. So high net worth individuals, according to the report, and everything is in US dollars in the report, it's 1 million in assets. Ultra high net worths are 30 million in assets. When we talk about the prime property markets, they are the top 5% of the market around the world, but also in key locations. So it's not the entirety of the marketplace. It is only the slice of the top 5% of the market. In the report is one of the key pieces is called PIRI, the Prime International Residential Index, the top 100 locations around the world. But bearing in mind, these are the major financial centres, gateway cities, and second home environments. So it's not every market across every city. It's just those key hubs where high net worth and ultra high net worths tend to purchase. And the other sort of term and phrase that you'll hear me talk about in this, which is what Scott was talking about, globally, we would call co-living the private rented sector, or out of the States, they call it multifamily residential. So there's a couple of different terms for it. In Australia, they tend to call it co-living. So in this document and in the wealth report term, it's actually PRS, it's private rented sector. And even though it is residential, it does tuck under the commercial assets. Okay. So just talk about some of the high net worth and set the scene on what was happening in 2022. 579,000 ultra high net worth individuals in the world in 2022. So people with assets of 30 million plus. That is a 44% growth in ultra high net worths in the 5-year span. Remembering this report, as I said earlier, has been in existence for 16 years. So there's quite a bit of background data that we can draw on it to pull these statistics. 16% of those is the regional growth in the Middle East of ultra high net worth individuals. The fastest of that Middle Eastern market is actually the UAE, which had an 18.1% increase in the last 12 months of ultra high net worth individuals. The high net worth trend is actually, so back down to the million plus asset, increased 2.9 in the last 12 months, and there's actually 70 million of those worldwide. The top 3 fastest growing wealth hubs were actually in Asia, and they were Malaysia, Singapore, and Indonesia. And the report's seeing that 59% increase in high net worth in the next 5 years, which will take that up to the 100 million mark, and 744 ultra high net worth, so 28% increase in the next 5 years of people with assets in 30 million plus. The one just above that ticked over in the last 12 months is the billionaires. It actually declined in the last 12 months, 5%, and it's down to 2,629. Okay, so that just sets a little bit of a picture of what's going on from the wealth perspective. A breakdown of the populations, and this is a little bit what I was talking about. There's actually a 3.8% decrease in the ultra high net worth population. However, in 2022, there was a 9.3% increase in 2021. So it's just averaging out slightly. So it's not that concerning. The wealth fell by average of 10% across the performance in the markets. And that was really due to the equities and bonds, which had their worst performance in years, actually since the 30s. So property obviously rated and stayed quite stable, but it was the other factors in the portfolios that had that decrease. However, of the advisors, they're saying 69% of the advisors say that their investors will see an increase in growth in their portfolios in 2023 as things start to average out. The other thing that's worth noting in all of this, as I'm talking about these numbers, as I said, the wealth report launches in March of each year. We're obviously now in June. And the data is actually collected in November of the year before. So we're in a market at the moment where things are moving pretty quickly and numbers are correcting and changing as we speak. So you'll notice that there will be a few little things in here. And if I have the most relevant and updated information, I'll let you know those numbers, which will be different to the wealth report. Okay, so of those 579,000 people, let's have a little sneak peek at what their little portfolio makeup actually is. So primary and secondary homes is 32% of their portfolios. And I think you can read through the rest of those there. I hope that's quite clear for everyone on the screen there of the breakup of their portfolios.
That's fascinating. I've never seen that before.
Yeah. Well, see, that's why it's very good for, when you're collecting this data, is actually to go to the advisors, because they have all of this information at their fingertips. So they know what they're investing their clients, what they're advising them to do, what they're coming in and out of, right at their fingertips. So it's actually really interesting data. And to dig in a little bit more, I haven't here, but actually in the back of the wealth report is the data bank, and it breaks all of this down in further details. So if you're super interested in understanding this, just go onto the site and download the wealth report, and you can see the data bank.
So Scott, do you propose some of these things generally within your whole?
Yeah, well, I
asset
think
class?
like for me, if I'm looking at alternative investments, you've got commercial property, you've got private equity. We're not doing it through funds, so it's just interesting looking through it. I mean, next month we're doing gold, so it's just interesting looking at. I'm quite surprised equities is only at 26%, to be honest. Generally in terms of portfolio, and one of the things that I've been reading about is that the ultra high net worths are pushing up to 50% plus in alternative investment. Now, primary homes and secondary homes would fit into that alternative space. So it's pretty, I mean, look at that, 32 plus 21 between residential and commercial, it's over 50% on its own.
Yeah. But also remember, as I said in the earlier, this is a very select clientele that we've gone to around the world. The other thing too is you'll see, I think I have it in here, the amount of properties that are owned per client. I think it's something like 3.8 houses on average, whereas in the Middle East it's nearly 6. So it's not surprising that the residential side is pretty high.
No, look, I hear you completely, Fiona, but I think also what I'm trying to share with my fellow masterminders is, that philosophy I keep saying over and over again. If you want to get wealthy, copy what wealthy people are doing in many ways. And so, yes, this is the select crew. I get that, but it's 500,000 plus people around the world, and that has literally access to the best advice in the world. And this is what they're doing, So yeah, that's my take. I'm not saying it's right or wrong.
And also maybe just to you're perfectly right. Maybe just to set that scene. Knight Frank actually sell homes to the ultimate homes around the world. So I think that without telling any tales out of school, pretty much the super high net worths are the ones where all this information is actually coming from.
Yep, perfect.
Okay, so let's go on to the next thing of what they're looking at next. So it does keep changing. As I said, this data was collected in November last year, so it will start to change a little bit, but a third are looking for property investments. They're looking to increase their investment portfolio, and 29% are going to reduce debt volumes. So it's interesting how these scales keep changing.
So what does that middle one mean?
So no change.
Yeah.
So they're going to hold them. They're going to sit on them and hold them. Some of them are going to decrease.
Okay, so that's
but they're going to increase.
So the 100% of the. Do you guys understand how that reads?
I think so. So my take on it. Let me tell you what I think, and then you can tell me if I'm right or wrong. But if I've got an allocation or in cash, just to keep it simple, what I'm basically saying is 28% people are going to keep their cash as is. 46% are going to increase their cash holding, and 23% are going to reduce their cash holding.
Correct.
Yeah.
So more people are going traveling this year.
Correct. That goes on to my next slide, Scott. Good little segue.
Come down to Australia, Scott.
And this is why this digital nomad boom that's happened through COVID, you've got a completely different behavior of people now and what they've been buying and what they're actually looking at moving forward. So the change in behavior is due to COVID. Everyone's they've gotten used to actually working from home, lifestyle oriented, the digital nomad. There's medium term residents. So this is why this 13%, some people want to live in the UK for a while and they want to go and live in the sunshine for a little while, or they want to go and live in a chalet for a while. So there's this big change and big driver that's going on with this medium term residency. What that also means is that the rental sector is that'll start to increase. But it's also the interesting thing is that lifestyle and education driver that's going on, which it's clearly outlines in the report. They're saying that it's actually outweighing any tax and financial decisions. They're very, very skewed on lifestyle. So whether that's healthcare, quality of life, or community involvement. So whether that's around family and friends and what have you. So there's a real lifestyle driver. And then there is the educational side of things, so which are a little bit like the safe havens. The US, the UK, and Australia are real drivers for those sorts of pieces, and not so much on the tax issues. But again, remembering the type of client that we're talking about. We're talking about ultra high net worth, so 30 million plus. But good one, thanks. So PIRI, as I mentioned before, this is the Prime International Residential Index. So luxury house price growth slowed 5.2 in 2022. But if you take out 2021, which was an extraordinary year, 2022 actually posted the highest level of prime growth on an annual basis since the GFC. Okay, so this is where you got COVID in the middle of these things, where it skewed results year on year. So some of these things you really need to dig into the data and have a really good look at the motivators behind them. The 17% of global high net worth did purchase in 2022, which was the second strongest year on record. So that, yeah, the second year on record. If we go to the next one, I can show you where they started to purchase. So what was hot in 2022 was Dubai, Aspen, Riyadh, Tokyo, and Miami. Now, the some of the little pieces of why Dubai was so they had such an appetite. It did come from a low base, so it did get a bit of a kickstart. There are these visa offerings with no sponsors in Dubai now, so that's made quite a significant difference there on what's going on. Obviously, tax is a big thing, but the key thing was the gateway city, so the airline traffic. So where people were no longer routing through some of the Asian cities, they're routing through Dubai, and it started to, and in there, I haven't spoken about it in here tonight, but in the report, there's actually an article just about gateway cities, which really looks at Dubai's market and the Singapore market on how they have really started to increase. But you can see from here, it breaks down to city locations, it breaks down to the sunshine locations, so that big trend in resort, and then the big trend in the ski locations, and then broken down across the different markets around the world. From an Australian perspective, you can see the Gold Coast there. The Gold Coast has, I'm going to say, I don't know the number off the top of my head, but the Gold Coast would have had record sales in the last 18 months. Prices have increased significantly on the Gold Coast, purely again because of that lifestyle. People were leaving the Sydney and Melbourne markets, buying and relocating to the Gold Coast, and that is a trend that we're seeing. It has continued. The next slide, I'll just let you have a little look at for a minute, because that just tells you all the other cities around the world and their price changes. Okay, but do remember, this is the top 5% of the market in these cities.
Brisbane.
Okay.
Okay.
And Brisbane, where we are, is number 82.
There we go.
Yeah. Quite interesting peptones. Yeah.
Yeah.
Okay, so some of the push and pull, some of the good news and the bad news, some of the things that are going on. You know, obviously markets tighten. I mean, this is not the first time we've seen these things happen. New legislation and new policy measures that come in, but the interesting pieces are the things that are relaxing. So there's a few changes that are going on in Canada that have already happened for non-resident buyers, sort of tightening that and closing that down. Tighter lending rules in Singapore, but then on the flip side, Singapore's visa relaxation, where they've had, if you're in technology and financial sectors, there's relaxation there, and a little bit of an easier way of getting, I know because I went through it, an easier way of getting visas to work in the Singapore market. Australia's had some higher fees that they've introduced. Spain has introduced a wealth tax, and there's a mansion tax in LA. So there's a few little things going on, little bits and pieces that you need to be aware of if you are in that ultra high net worth arena, which I'm sure all of the advisors are talking about, but it's explained very nicely in the report. So the next slide, my favorite one, the bang for your buck. What do you get for $1 million around the world, size-wise? Well, no surprise, Monaco is the most expensive city in the world. And I don't actually remember doing a report where Monaco wasn't number one. But what was interesting this year is that New York leapfrogged London for the first time, only by 1 square metre. But there was a change there. As I said before, Dubai's price increase have been impressive. But that, as I said, they did start from a low base. So Dubai, you can buy 5 times as much space as you can in Hong Kong.
Sure.
And you do quite nicely there too.
Yeah, Cape Town's there.
Yeah.
Yeah.
Get a lot of bang for your buck in Cape Town. Okay, so Scott, this was interesting when you mentioned gold just before. Safe as houses, global high net worths consider residential to be the safest asset class, which usually is the spot for gold. Every other year, historically, gold has been the safest asset class. High net worths motivated to purchase investment assets, 62% of them are looking in the Asia Pacific region.
Where do you see that?
That's just a little bit from the data bank, which is not in that infographic there. Yeah. So again, this is, I say, when you dig into the data that sits behind, you can see some other key trends. Okay, so we can go on to buying patterns. So Australia actually is leading the Asia Pacific investment destination. So where I said just a moment ago that 62% were looking at that Asia Pacific market, it's actually Australia from an investment perspective. The other markets there, you can see the number one buying markets around the world with France, Spain, Italy, the UK. You can see all of those sun cities that we were talking about before, the ski resorts, the lifestyle orientation, and then the UK with the educational pieces. That's a nice little breakdown to show you that the French are looking at the UK and Switzerland and the Netherlands, and then the Swiss are looking at particular markets. So that's a nice little, you can see there that South Africans, you're looking at the UK and Germany and Austria. So that's a nice little trend of what you can see, but then the overall part of it is that Asian piece that seems to be going on.
Where's the Asian piece? Sorry, just so that I'm aware on the diagram. Where
So you need to look in the data bank.
Oh, in the data. Okay, so it's not on this.
And you'll see the trends in there.
Okay.
And actually in the report, there's a full article on it of what's going on in the report in the buying patterns area.
Okay.
So just to give you some headline numbers, there are the actual portfolios, 3.7, I thought it was 3.8, 3.7 houses, up from 2.9 from 2021. So there has been a little increase there. The top 5 markets of the US, the UK, Australia, Spain, and France. And why is that? It's from that, as I said before, that lifestyle, the currency, the stable governments, and the high level of transparency in purchasing. The residential assets, 250 trillion is the size of the market, as opposed to the stock market being 90 trillion. So it gives you a little bit of an idea of how that sits in the, and again, I'm talking about prime residential markets. And 15% new property in 2023, down from 17, I think it was, for last year. And 28% of assets held outside of their actual domicile country.
Cool.
Okay, so let's talk about the property that's in demand. 19% of ultra high net worth individuals intend to buy income producing property in 2023. So that brings us into, as I said, the commercial sector. So the data is actually captured in commercial for this prime rental sector. So if we go to the next slide, Scott, you can see that the private buyers had the highest share of global commercial investment on record. It was the first time that private buyers have surpassed institutional investors. And the sector of choice for them is the multifamily private rented sector, as I said before. Okay, great. So the global appetite for real estate, for commercial property. So as I said, 19% intend on investing in income producing property. 40% considering investing in commercial outside their country of residence, and 24% direct investment into Australasia.
Sorry, well, how much was that? 20%?
24, you see on the little Australasia, the bottom right?
Oh, there. Oh, I see what you mean. Okay.
Yeah. And you can see that the colours, the way they're split, is direct and then indirect.
Got you.
Okay. Then if we go to the next one, that shows you the asset classes. So as I said, number 3 on that is the private rented sector.
Just before, sorry, Fee. Scott, can you just go back one? Only because this is a bit relevant later. Fee just mentioned how you've got the directly and the indirectly, and up in the top right-hand corner, you can see indirectly, e.g. through REITs or debt funding. Yeah. So we'll come back to when I'm talking at the end of the presentation. I just want to highlight that because those REITs, real estate investment trusts, is a very good vehicle and a very well-established vehicle of investing in assets that are quite significant in terms of value that are outside of the reach of most high net worth individuals. So we're talking many millions as opposed to a few low millions.
Okay, so as we said earlier, the income producing asset, which is that private rented sector, the appetite, it shows the appetite there for them at 32% for 2023. And as I said, that private rented sector, when we talk about that, that is co-living as well, or what you'd call multi-family residential.
Okay. And just as my interest for everyone that's here, you know, we've done one asset class on medical or this healthcare sector. We've done one on industrial. We've got offices coming, and we're doing, you know, the private rented. So I'm just giving people an idea of what we've been through already.
Oh, good. Okay, so this slide just shows why and why Australia. So I've just highlighted Australia there as the one at the end, and you can see I've highlighted the private rented sector. Remembering this data is data from November last year. So historically, the asset class being the income producing, the lifestyle features, the currency, the stability in the government, the high level of transparency is what's driving this private rental sector historically. And what we have seen is that it has started in the Sydney market, predominantly in the Sydney market, with much smaller holdings of 10 to 20 rooms, it says there, but really they're sort of up to 50 or 60 rooms. And that's the appetite of what people are talking about there. The reason for this, in Australia, there's a massive housing shortage and an undersupply, and the need for the medium-term residency. So this is why in the Sydney marketplace, this has started to, it has been a very explosive asset class. So if we just move on, so what we've actually done, I've gone through the key findings at a high level and very quickly of the wealth report, but you're more than welcome to download and have a little look for yourselves and read the report in its entirety. Have a look at areas that really interest you, as opposed to what I've chosen for us today. But Scott's invited us along here to give this presentation not only on the wealth report. We obviously look at it for what we're doing with our portfolio and asset classes, and where we're actually looking at moving into next from healthcare. And this obviously is a sector that we're very passionate about, and we're actually moving into ourselves. And these are all the reasons why. The wealth report has confirmed for us that the ultra high net worth individuals are looking at this as a sector as well. It's something that's very topical in the marketplace here. It's something that the rental sector is on the news for us and in the media every day. The healthcare assets, with what Nathan's done for us, is we've been there and we've done that, and that's been great. But this is the new market opportunity that we're looking at, and particularly because the city that we live in now is actually the Olympic city There is a massive demand for residential, as I said, and the demographic works really well from an investment perspective. So just to showcase a little bit more and dig into what this rented sector looks like, if we go to the next one, Scott. So this just shows you in America, one of their key they call it co-living there. One of the key co-living places is called the Common. Again, a little bit different to different countries that do different things. In America, they tend to be more share house environment as opposed to co-living, which is a little bit different to then the next one, Scott, is the Collective in the UK, which is a little bit more co-living oriented. It's more like a, what do you call it? Like a service department type environment, where they're anywhere from 12 square meters to 20 square meter private apartment with all shared facilities. So that's the Collective. And then here in Australia, as I mentioned, we have in Sydney, UKO, and they are probably the biggest operator in Australia. Most of their assets do sit in Sydney. They've got 25 complexes across the Sydney marketplace and are looking to expand into the Queensland marketplace. So we are talking to them about being our partners on the project here in Queensland. So that's me, and that's a little introduction into where we're segueing, and I'm going to hand over to Nathan to talk to you about the actual asset in Queensland.
I haven't done as much detail as Fiona has, so thank you for that, Fee. I've seen her sort of be quite diligent to read the report, which is obviously hundreds of pages long, and the data, and try and give today to try and give you guys a bit of a sort of snapshot on what's gone on behind the scenes to get to some of those numbers and highlight these key numbers. But what I found interesting in the conversations we've been having behind the scenes, and then what Fee's just shown you today, is it is this lifestyle element that we think's a really important asset class. I would also throw in the word wellness into that. As we sort of mentioned before, and Scott's shown you, we've got a deep background and history in hospital assets primarily, and there's a lot of that's around mental health. And yeah, Scott, that's good. Leave that page there. I'll come to that in a second. And really, when you look at hospitals, and as I said, we did our first day surgery center. The first one we built was in '96. We started the businesses in '92. It took that long to get that first one out of the ground. But what that really is that's the sickness business. And where we are today is people want lifespan, people want health span, people want longevity, people want a better quality of life as they get older as well in terms of their wellness. So, and there's literally an explosion going on in the medical world of, can you hear me there? I might just do that. There's literally an explosion going on in the medical world of preventative, personalized technology. Yeah. And I'll give you some examples. You can do a blood test now that identifies 50 cancers through a process that includes some AI. The same thing to do with your heart. So they come to the calcium scores and show you at a very detailed level of what certain risk factors you may or may not have. You can talk about things like stem cell technology to rejuvenate some of your body parts that may have damage. You can talk about therapeutic and diagnostic technologies, that from CTs to PET scans to a whole host of other stuff. Scott mentioned we use VR to do brain health assessment, and this is just the tip of the iceberg. Everyone would have seen in the last 6 months all the noise around AI and artificial intelligence. That, from what we're seeing, that being permeated into large healthcare data sets is going to be quite extraordinary of what will happen in healthcare. So we are saying, our group is that we are moving from that sort of healthcare, and I'm going to put that in inverted commas, which is really sickness industry, into the wellness space, which we've seen coming for some time, that's now growing exponentially, which is fantastic for everyone to extend their life with quality, extend their biological age to live past 100 comfortably. These are, if you're reading information and seeing that's out there at the moment. And what's interesting is that then you've got groups like this group here, which Scott's just pulled up, which I shared a presentation to him a couple of days ago, called the Global Wellness Institute. And they're now trying to incorporate it into property. And the reason what they're doing, and that's not talking about doing a day spa, that's talking about a whole host of things that you could do within a community as well. And that's where we go back.
Want me to pull up that report?
Pardon?
You shared that report with me. I've got it. Do you want me to pull it up for you?
Yeah, you might as well pull it up to give people some sort of context. And the project that we're about to talk about, and where Fiona's gone down the process of the identification. Okay, we did see healthcare, but then we came and you're talking about how people live within their environment and their community. And that's what part of this, and it actually even goes to the mental well-being of people. That's where we see, for example, the project that we're going to talk to you about, the purpose-built co-living facility that we're looking at here in Brisbane. And yes, it's going to have other elements about well-being because it's near pools, it's near gyms, it's near this, and what people eat and the rest of it. That's not part of the actual property itself per se, but people want these types of services, and that's what a co-living facility is. It's how you actually also run the facility. And that group that was mentioned before, UKO, we went down and inspected their facilities, and we're dealing with the CEO there. And I'm very sure they've got about, you can see their website, they've got about 25. Here's the wellness. You'll see there, wellness, real estate, and community symposium. So it's all about how we as people are going to interact. And a lot of it, Fee mentioned before, a lot of it stuff's been driven the post-COVID era. But if you just scroll down a bit, Scott, there's a nice little quote that I sort of liked before.
Which I don't know
what.
First
paragraph, you'll see the last line. It says, doubling 2020 to 2.75 billion and set to double again to 580 billion by 2025. I mean, they're incredible numbers. But that last paragraph, it talks about the luxury spa real estate. So it's gone from the old to moving from medical and diagnostic to being the cornerstone of some projects. So that's on a scale of, if you have thought of a bell curve, this sort of lifestyle wellness community space that we're talking about doesn't include a hospital, doesn't include an aged care facility. Yes, you can have the sort of the resort style complexes, but you're also going to have very good community living facilities, which is what we're talking about right here. And some of them you'll start to see, in particular as they get more higher end, will really incorporate a lot of senses in the home and all these sorts of things. So where we sit at the moment is that, we go back to our presentation, Scott, is we have identified a site.
Sorry, just quickly, there's nothing more you want to go through here, huh?
Yeah. Well, when you go back, if you just read some of the people that are actually involved in this, like I know, Deepak Chopra, he's been hired by one of the largest property groups in the States to sort of include, and how do they're starting to think laterally. The collaboration you can see in the communities. I mean, Scott, you can share that. Here we go. During the pandemic, wellness real estate continued to grow. One of the most robust wellness sectors. You know, people want that connection. People want to understand more about their well-being. So there's a whole, and this is only the start of it in the space, because what we do see is this whole preventative medicine angle, wellness that we see that's going to become quite ubiquitous. And how does that marry into properties? And people want lifestyle. They want good quality of life, especially as they get older into their retirement.
Just in terms of, a couple of trends because we do a lot around trends. And if you look at aging populations, the US, China, Australia, UK, Japan, they're all aging populations. And it's just, and they obviously are core markets based on what Fiona just shared. And it's just important to, again, be focusing on like which markets. So even today, the last 3 months we've been in America, now we're in Australia, and we're there on purpose based on the data you've seen today.
Exactly.
Okay, you should be seeing my PowerPoint again.
Yeah, that's good. So just on that slide. So this group we're talking about, we went there, and I mean, a lot of stuff gets done through the app of how you check in, how you monitor things, how you get other things, how the services that you might want to buy, the within the community, how you communicate to each other on certain things. The project, if we go to the next slide.
Sorry, just give me 2 seconds. I was actually just searching for UKI, the website. I'll show them quickly here.
Yep. There you go.
If you go to the one, Alexandria, that's a really nice little example.
That's the one we saw. So basically what this is, you're going there and you're paying, you don't have to pay the bond. You don't have to bring any furniture. You just have your suitcase, literally. And you can see they've got studios staying from $600 a week. And you do sign up for minimum periods to stay. 3 months, and they say their average stay is 6 to 9 months. And they're full. They're 100% full. And they've actually got, they actually don't have any vacancy, because they know when the next person's coming in, because the next person's moving out. So they've got the whole waiting list, and because it's such an easy process for people to come in and come out, you don't lose, like if you're in the hotels, you can lose time sort of bedding and fixing rooms and all that sort of stuff, or non-shows and people.
I'll put this link into the chat box just so people have it, and then I'll go back to the chat to the presentation.
That one's a nice little example because of the location of it and the demographic of people. But as Nathan said, all of their properties are actually full.
Yeah, and so if you go to the next slide, Scott. So this is the one that we've got in Brisbane that we've identified, and that's at Chermside. So it's not in the heart of Brisbane, but it's about 10-15 minutes out of Brisbane, depending on traffic. And it is basically in between, a couple hundred meters each side, the largest medical and research precinct in Queensland, being the Prince Charles Hospital, and there's a whole set of private facilities on that. So you've got that whole medical community, and you've literally got thousands of people that work there. Then across the other side, so as I said, it's just stuck in the middle of it. The other side is the largest retail and transport hub in southeast Queensland, which is part of the Westfield Shopping Centre group. So all the buses, all the transport, everything goes out of that hub. And the one thing that is being underestimated here, and we sort of haven't really highlighted it, but it's 9 years until the Brisbane Olympics. And what you've got at the moment is a boom going on in Brisbane. There is a housing crisis. It's on the news the whole time. Brisbane's now growing 3 times faster than Sydney, 2 times faster than Melbourne. And because you've got this boom that's going on to build these massive pieces of infrastructure for the Olympics, you're talking stadiums, you're talking trains, planes, automobiles, the whole show, railway. The biggest issue at the moment is now become the housing crisis, because everyone wants to be moving up to Brisbane. You want this lifestyle up here. You've got the concept to go to the Sunshine Coast, the Gold Coast, which we mentioned before, that hour each side of this location. And so what you've now got is a facility that we believe has got huge pent up demand. Fiona did some research the other day, and the landchecker.com, which is one of those little quirky things that people in the know, talks about what's available for rent and how many people are applying for it, and give the numbers, Fee.
So it was actually for the month of April. So the data, there were 64 properties on the market, but there were 2,431 people applying for them. So
Where
that's
was that?
just
Where was that, Fiona? Which area? Like
Chermside.
60 in where? Oh, in Chermside, yeah. And how much? So 64 properties available, and what was the
2,431.
Applicants. It is a massive issue. You guys can do all the Googling that you want in Brisbane, and you'll see it is a housing crisis. It's a rental crisis. So the government's coming out and they're now talking about incentivizing developers and all these sorts of things. So we'll throw a hat in the ring, and it's that build to rent type stuff. But there's also affordable housing for the less fortunate as well. There's a lot of issue of homelessness that's starting to creep up. But normal people could come to a facility like this, and that's that nomad that we spoke about, that transient type person that might want to come and live in Brisbane for 6 months or a year, or someone that wants to come here first and then find a base to stay, or a couple that might have separated and a divorcee, or there's a whole. It's just not that student market. It's that 25 up group, and that's the target of the UKA that we showed you before. But that's a really well located facility, and if we showed you the plans, what you'll see is a lot of common area of shared spaces, which is a big part of it. That's so that you might have a sort of a 25 square meter room, but what you have is the pro. Now this is on the Wealth Migrate site, as in previously that the guys did it. So we've now come in and we now believe that this project should go ahead. So with our background and experience, that's what we're going to do. We're going to take it from the DA that it's got at the moment to a BA and to have the project developed. And so we've been down to Sydney. We've met with that other group. We believe you need an experienced operator in there, and we've got some key financiers. So very shortly, we'll be able to share with Scott the opportunity of how you can invest in that, which is in the next slide.
You want to go to?
Yeah. So what you have is how you would actually, the structure that will allow it to go from where it is today to become a trading asset per se. At the moment, what it does have is a lot of approvals to it. What's not happening to it is the construction. So it needs to go into what we call a registered managed investment scheme, and that works with the Australian Securities Investment Commission, and ASIC, which is the financial body here. And you have an investment manager, which we have as an independent person. They are what you call a responsible entity, which is on the left there, and that then meets the highest level of compliance within the process for it being able to be having investors' funds come into it to develop it, because that's where it's got to. It's got to that point now that the asset, and I could see someone before asking the question, is it on the site? Yes, it is on the site, but we're now going to transition it from the DA process and that value to now going to the actual building of the asset itself.
BA, I presume is building application. Is that correct?
Yeah, development approval. And BA is building approval. Yeah,
building approval. Yep.
Yeah, and what this here, I mean, that's a nice shot, but you have a structure like this, you meet the highest compliance standard in Australia, which is ASIC. You actually have to have a responsible person who has to have certain qualifications to be on a company that becomes the responsible entity. That's not us, that's independent. They then would have they're called the investment manager. We then as a group turn around and say, okay, well, let's develop the asset, build it. And then once it's complete, within that fund, you'll have not only the completed land and buildings, but you'll also have the operator, you'll own the actual trading business. The operator being that other group, potentially UK, I haven't signed anything with them, but potentially them would manage and operate that facility. And then what happens is you then, start to do distributions and returns, and that's on the next slide. We've got some target numbers.
Just before we go there, Nathan, just talk to us a little bit, because you've had experience of this for nearly 30 years now in the medical space. And it's been really interesting for me understanding the difference between owning the real estate and also owning sort of the operational business, and just how you kind of did that and what you've learned from the medical space and the REIT, et cetera, and why you think there's a parallel that can be copied here in the co-living space.
Yeah, so it is slightly different to the hospital stuff, but it is effectively the same. So when we looked at the hospitals, they get to a point which is not like this, where they're trading, and you're buying the asset. And what is the asset? The asset is the land and buildings, all the equipment within the hospital, and the operating business of the hospital. So what we did is we separated out that equipment and that operating lease and ran the hospital. But we did, in the early days, do it like this, where we had an operator that we worked with, and you do the asset all at once. And when the asset's, inverted commas, mature enough, you've actually got two assets. You've got an operating business that's the trading business of renting the rooms, etc., and then you've got the land and buildings. And at that point, what you do is you enter into what you call a triple net lease, which is a head lease effectively over the whole asset. And that is the trick of where you then pay a rent that gives a value on one hand to the business, because it's going to make an EBITDA and a profit. And on the other hand, you have a traditional rent under a triple net lease, which is over the whole asset. That means you've got to maintain everything from the air conditioners to all the plant and the whole 9 yards of the asset. So we will, at a point in time, have it so that if we want to sell that business under this structure, we can. That makes sense?
Yep. There's a question here. What are the post-Olympic impacts?
Well, our view is it's going to be not going to stop. I mean, Queensland, as I said, at the moment, Brisbane is growing 3 times faster than Sydney and 2 times faster than Melbourne. And it is lifestyle. It is weather. It's that whole the sea change that we had in the sea and sun. We've got it all up here. So yeah, we feel as though that whole many cities don't have that slump post it, but you got to remember there's 9 years until the Olympics, so we've got plenty of time to get it right.
I think what you just said, is also important in terms of, so yes, I mean, you've got to be careful of Olympic cities post, but I think it's a valid consideration. The other thing that I think is important to back up what you just said, Nathan, I'll never forget when my uncle moved to Australia in 2003, and he moved to Brisbane, and I was like, why Brisbane? And it's interesting because he's an incredibly successful asset manager in the wealth space. And he said, no, because people are going to move to lifestyle. And it's weird because he was about, 17 years, before everyone else sort of hit COVID and was doing it already. But he said, the Gold Coast in Australia, Spain, Portugal, Florida, Texas, California to some extent, that's where people are going to go for lifestyle, and it's happened. And I think those trends actually are quite a lot bigger than a one-off Olympics,
Yeah, exactly. And there's been a few legacy things that they've done over time here that have really made the city. Like one was one of the World Expos. That area is just a beautiful part of the city. But look, Brisbane is, and that I'm going to say the southeast Queensland region. You've got Sunshine Coast, which is preservation nature. Then you've got those amazing islands like Moreton Island. I mean that, the Tangalooma Resort, for example, and that's just pristine, beautiful. Fraser Island, incredible parts of nature. Then you've got the city itself, which is growing as I mentioned 2 or 3 times. It's fastest growing city in Australia by a long shot. And then you've got that whole corridor down to the Gold Coast, and the whole Gold Coast area is the same. So you're in Brisbane, you want to go south, north, you got it all here.
So Graham said, who's in Australia, Sydney just went ahead after the 2000 Olympics, plus we have 800,000 workers short that need to migrate in the future. So it's that whole immigration. I don't know exactly what the stat was. I know when I started investing in Australia in 2009, it was something like, a new person arrived in the city and there was a certain number like every week, actually. And again, back to population growth, you're dealing with qualified, you're either dealing with people that have skills or you're dealing with people that have money because of, how, you're not dealing with lower class immigrants. And then, a bit of a joke here, but Graham says the only thing wrong with Queensland is it keeps winning the football state of origin, which is effectively their regional competition.
Yeah, touch wood, they've got a big game coming up. And then the last slide, Scott, is basically, what do we look at for metrics on a structure like that? Well, because there's about to be a development, as we've just said, you want to have the investors coming in with you today, making a 20% margin plus on the total development cost. So all the cost, the land, everything, you want to make another 20% as a minimum on top of that. It's a good target. And then once it's trading, as in post completion, so year one, you want to start at least 7% of a year of a distribution that you'd be giving to the unit holders that have come in, and at an exit on a sale, which once you got to that second year, if you stabilize the asset, I think it'd be very attractive. That's a personal opinion, but there's a lot of empirical evidence around that as well. There's some large funds that are coming into Australia to look at this type of asset. You'd want at least a 13% IRR. So they're nice, good metrics. It's residential. It's got the rental income. You've got that purpose-built co-living, that asset class that's not really quite here yet. We haven't really seen significant ones here. There's a few build-to-rent projects that are coming up with various other bits and pieces and subsidies, but some of it's more lower-end market. And so that's the end of the presentation.
Awesome. So guys, listen, I think what's important here in terms of the space and just in terms of some of the research as well that I've been doing in the space is that you'll find that co-living, and it's interesting because I would have thought that co-living was something that in COVID, people not wanting to live close to each other because they might catch COVID. And it was actually the complete opposite. People didn't want to live in flats on their own and be isolated. They wanted to be, in environments. And so it's institutionally really sort of taken off in the European market and in the American market. And institutionally now, as Nathan and Fiona mentioned, there's quite a lot of push into Australia in terms of the space and what's happening. Just talk to us quickly, Nathan, in terms of your conversations with UKO, etc. Because again, my understanding of there's two conversations I'd love you to have, if you don't mind. And I'm putting you on the spot here, so if you don't want to have them, then so be it. But my understanding of succeeding in anything is always going to the best partners, getting the best information, best partners, always, And so, my understanding in terms of your REIT structure, you were in Sydney last week, and the whole idea is to go with one of the best literally in the country, and then on the structuring side, and then equally on the, on the execution side. Do you want to talk a little bit to that, or can you talk a little bit to that? I don't know. I just think it's important, from an execution perspective.
Yeah, no. So we've met with all the right people at the UKO. That's a few times now, and conversations also via Zoom and telephone and the rest of it. So yeah, we're at a point now where we're looking at finalising some documentation with them. The conversation's gone very well. They seem to us to be the logical group. The previous group that was working to get the DA, a group called Highgate, their project management style company. We've met one of the individuals there, so very happy to keep those discussions going because you do need project management in it. But yeah, I think what you're saying, Scott, to get this away is quite chunky, which is what I spoke. Why I highlighted that direct and indirect slide that Fiona had having the REIT structure is that it allows a host of investors like yourselves, like us, we'll be putting our own money in to an asset that's going to be worth some tens of millions, but we couldn't do it ourselves, and that's the beauty of that structure. So what we have done is got an ex-partner of Ernst & Young at the Sydney office, who's very well known to us, who passes that ASIC requirement as a responsible person. And I've used those words specifically because that's a definition under the Australian Securities Investment Commission, how you govern these things. And then that allows that company to enter into what you call an investment management administration agreement. And it's got all the rules on how you do the trust. And then basically what happens is a very transparent document that gets produced, effectively an information memorandum. And it outlines all the things of the details of how it works and who runs it and who does this and what the expectation is of the returns, which I've given you some indication there. And then
Does
people
anyone-
Yeah.
Sorry, sorry, I didn't mean to interrupt. What did you say, Nathan?
And then the decision then is for people to invest or not.
Yeah, yeah.
It's
So I
very, very, very similar to when I introduced you to the Sentinel Group and to Warren Ebbett and that syndicated type model. We've also done that previously, as I mentioned, when we did the Essential Healthcare Trust. You do so. There's different managed investment schemes, is what they're technically called, real estate investment trust. But we're finalising all that now because we're looking to have all this finished literally in the first few days of July.
So I think just to recap, and then I'll wind up. And if anyone's got any questions, either put up your hand or just type away. But just to recap, if I go back here, what we're trying to do as part of the mastermind is give you access to both the information and the partners and I didn't actually know this in terms of the research that Fiona shared with us, but in terms of the ultra high net worths and where they're looking to invest in 2023 and which asset classes, if you look here, you've literally got healthcare, industrial and logistics, you've got offices, and you've got the residential, the PRS. And, they're almost much of a muchness in terms of that overall process. So, these, when we talk asset classes, these are the things that we're trying to focus on, which are the core assets at the moment that people can get access to and participate in. So that's one. So you want to look at asset classes, but then equally you need to take regional diversification into account, because personally, I don't want to have all my money in America and be exposed just to one country and one currency. So what we're very purposely doing, and that's why Fiona's presentation was so valuable, because you see the regional geographic distribution that people have, and it becomes critically important to not only look for asset class sectors, but equally to look for country diversification in terms of that process. So, Hanu, I can see you got your hand up.
Hi, Scott, Nathan. So I'm listening to the Financial Times of London podcast on a daily basis. And about a week or 2 weeks ago, I heard an interesting podcast that in the UK specifically, what's happening at the moment in the market is due to the market prices being quite high, the younger generation can no longer afford to buy property. So what they do at the moment is they go into a co-living type situation where they, instead of paying money towards the co-living, they will, let's call it, trade their services. They'll keep the house clean or the kitchen clean or whatever the case might be, obviously depending on the situation. And in exchange, they then live in the house and take care of the elderly individual, because that's mostly what happens. The elderly individual will own the property, but the younger one will, in exchange for services rendered, live with them and help to take care of them. Do you see that expanding further than just the London situation at the moment, or not really?
Well, maybe
I would say that, the London market is and very different to, London market and the New York market are very similar, but very different to what would be happening here in Australia. The London market is obviously super expensive. And you could see that would be something that would be needed, and also their issues that they have with their healthcare system and those sorts of things. So it completely makes sense to be doing that. And actually what a wonderful community-minded thing to be doing. So I'm not sure that that's something that we would see here immediately. I think Australia's got a different take on aged care and a different uptake on that. But definitely the affordability aspects is definitely something from a co-living perspective of what's happening here. But in our marketplace, it's more that sort of 35 to 40-year-old professional who actually doesn't want to be living on their own in a one-bedroom apartment, and they want to be living in a more community-oriented environment, which is what we're seeing the feedback we're getting from UKO in Sydney. It's that sort of demographic that we've got going on here at the moment.
That's a very
Yeah,
good
thanks.
question. Very good question.
I think
Because because in Australia, as Fee said, that it's a bit of a different aged care system where there's a lot of government support, the pension and stuff like that. But because the population is aging, it's got a lot of stress around it. There's a lot of talk, but they have the concept of the hospital at the home. So there's services where caregivers actually are paid by the government to come to your house, and that's over and above or outside private health insurance. But you can't do that forever, if you know what I mean. No, very good question.
I was going to talk to that a little bit, Nathan, because I think that's quite a big trend in Australia in the healthcare sector, full stop. I think the other thing that you're raising there, Hanu, which is a critical thing in these big cities, is affordability. I mean, when I last looked at a stat in England, and it might be a year or two out of date, so don't hold me to it exactly, but the average first-time buyer was 42, because that's how long it took to actually save enough deposit to be able to get into the market, etc. So if you think about it, they're almost, I mean, I bought my first house at 22, so they're missing an entire generation of opportunity, and affordability is such an issue. I personally think there's a space in the market, and I haven't even spoken to Nathan and Fiona about this, where you invest in not multifamily, co-living, or multifamily for that matter, and you let the tenants actually pay their rent, but let's say $50 a month actually goes towards owning the asset, so that they don't feel like tenants, they feel like owners, and you actually are starting to build their balance sheet longer term. Anyway, that's a that's a purpose-driven comment further down the line, but I think that's where the world will go personally, where the majority will be paid in rent, but a portion will be going towards owning the asset. And with the likes of crowdfunding and fintech, there's no reason why that's not possible. It also allows the larger institutional investor, let's just call it, some of the people that Fiona and Nathan are bringing to the table, to exit over time. So it's a win-win situation. I think, look, sorry. I think in conclusion, the last thing I'll say, and then if there's no more questions, I suggest we wrap up on this, is that one of the things that as an investor over the next 10 years that we need to be looking at is, where are the long-term trends? And there's absolutely no doubt that there's a trend of issue around affordability, whether it's Australia, England, America, and so this co-living, multifamily, whatever language you want to talk is a big space, and it's interesting to back up what you said, Fiona. There's a gentleman who I would love to get onto this mastermind, although he's very camera shy, so he basically refuses. It's not going to happen, I'm telling you categorically. But he's 3 generations British, and they've been doing British real estate in London for 3 generations. They're worth £500 million cash. They don't buy anything with mortgages. And he literally was the safest investment they can do at the moment is residential. So I'm just backing up your report, literally from a gentleman. I've literally spoken to him in the last 3 months. And, I think what you're offering here, the two of you, is for you and me, and I'm talking us as investors, to go out and try to find individual houses and try to own them and manage them is nigh on impossible. If you've ever tried to do it overseas, it's impossible. Whereas here you've got more of an institutionalized investment with not only the service company to run it, so you're not worrying about broken toilets, etc., but also an exit plan. Because if I own 10 houses, it's quite hard to sell 10 houses. But if I've got an asset, and again, I'm sorry, Nathan, but where you basically said stabilize the rent, what that means in English for everybody is you build a building like this, you fill it up with tenants, it takes a year or two to stabilize the rent, which basically means you can show consistent income returns. And then once you've done that, you sell it on to an institution like that. The whole value chain of real estate, that's the gameplay here. So this isn't a get in, get out, get rich quick scheme. Nothing we've shown you is any of those. But this is a trend that I think is very important over the next 5 to 10 years. So it's why I wanted to share with you. And I think the last thing that hopefully today has added value in terms of with Fiona's approach from a global perspective, like what are the high net worths doing? Because we really should be copying them, because they've got the best access to advice out there. And then secondly, from Nathan's experience, he's been there, done that in the health industry, and now they are pointing their finger at the at this co-living space and saying there's an equal opportunity to what we saw 20, 30 years ago in the health space. So I don't know, that's my synopsis on what we've been through today. I don't know if anyone else has any comments or questions before we wrap up.
No, and thank you, Scott, for having us, and
Yeah.
nice meeting you all. So it's been our pleasure.
Awesome.
And I hope you all become ultra high net worth individuals.
Thanks, guys. Thanks, Nathan. Thanks, Fiona. Thanks for
Thanks.
putting it all together. I really appreciate it.
That's
Okay,
okay.
thank
Thanks
you.
a lot. Bye.
Bye-bye.
Cool. Let's look to rock and roll and wrap up here. I will share this PowerPoint with you. Shane and I have been doing research on each one of the asset classes for you. So if you look here, and I'm not going to read this out, but effectively, what is the co-living space about? What are the key characteristics? So it's ultimately about shared spaces, the private living units, the flexible leasing, the community and social engagement, the amenities and services, the cost efficiency, and then the increasing popularity. So it's got huge popularity around the world with the millennials and young professionals who are looking for community, flexibility, and convenience. So that's quite important. And then just in conclusion, co-living caters for the growing demand of alternative and community-oriented housing solutions. It offers an opportunity for residents to live in a supportive and engaging environment while enjoying the benefits of shared resources and cost living. Co-living properties are typically operated by specialized companies or real estate developers who create the living experience and provide services to meet the needs of the residents. So I think that's the overall thing.